Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to our podcast. My name is Bert Salazar, and I am the host to the Bert Salazar Retirement Show. So welcome once again, everyone. And like always, we're here every single week, providing you with not only information, but more so education. So today's episode is actually episode number 162. So as you all know, we've been doing this for quite some time, and the title for this episode is Tax Planning is Paramount for Economic Survival. One of the main reasons, although I talk about taxation all the time, whether I do a webinar, a seminar, whether I do any speaking or engagements or anything along those lines, I do speak quite a bit about taxation, because if you're able to manage taxation, just about everything else is going to fall into place. But the one reason why I wanted to bring this episode up today is that over the last, I would say probably 30 to 45 days, I've been getting a number of calls from my clients and also calls from many of you out there in my online community, asking me about taxes and asking about, what I think about what's happening in Congress with the increases in taxes and all that stuff that is going to be coming down the pike. Now, none of it has been approved yet, but we all have to be ready, and we have to be ready because we have to be able to find ourselves at least one step ahead of everybody else, especially when it comes to the government and to the IRS and so forth. So what I want to do today is I want to take a few minutes and kind of cover some of the stuff that perhaps you have heard before, but it never hurts to hear it again, because at the end of the day, it's about, maximizing the internal rate of return on your investments while minimizing the amount of taxes that you're paying on an ongoing basis. So, what is the difference between taxes and tax planning? Well, pretty much taxes are what you pay when you don't understand tax planning, because if you do a good job in tax planning, you may end up paying a little bit of taxes, but it's going to be a lot less than if you don't do any proper tax planning from one year to the next. Now, one of the things that I do for many of my clients on an annual basis, especially my business clients, is besides doing their accounting and bookkeeping, and they're providing CEO services to them, I also do tax planning, because tax planning is something that you go and do throughout the entire year. See, when it comes to April, it's pretty much too late to do tax planning. You have to pay the taxes at the time. So anything you're going to do from a tax planning standpoint, you have to start doing that immediately, especially for 2029, because we're fast approaching the fourth quarter. So you have to be there and you have to do it, or we're fast approaching the end of the fourth quarter. So you got to get ready, and you have to be prepared. Now, tax planning versus inflation, and that's a question that I often get from many of my clients. And what I can tell you is that proper tax planning helps you offset the nemesis of high inflation. See, the challenge with inflation is that there's a global inflation, and then there's internal inflation. Now, the global inflation rate, and even that of the United States, is somewhere about around 5% today, which is probably the highest that it has been, at least in 2 decades. Now, obviously, the pandemic had a lot to do with it, but at least in the United States, we're doing things from a governmental standpoint that is not helping at all. And the reason why it's not helping at all is that inflation is not tax deductible. So if you have an inflation rate of 5%, depending on your tax bracket, your actual gross inflation is going to be higher than that. It could be 5.5%, could be 6%. For some of you, may be 6.5% because inflation is not tax deductible. Now, when you start to figure out, or you want to put your thumb on the scale of supply and demand, then obviously now all of these inflationary forces are going to start creeping up, and this is what is happening right now in the United States, because at the end of the day, our government is doing a horrendous job in the management of inflation, and most important, in many different ways, and they're actually the creators of inflation, because they're printing money like it's going out of style, and the more money they print, the less valuable the dollars you have in your investments and your savings accounts are worth. And that's something very, very important, because as inflation increases, just take a look at your retirement distribution planning. Take a look at your retirement accounts. Once you factor the taxes that you're going to have to pay on those accounts, then what kind of rate of return are you going to need in order to stay ahead of inflation? It's probably going to be a lot higher than what the market is bearing today, although the market has been doing fairly well, at least over the last 12 years or so, but it's something that is not sustainable from a business standpoint. So the minute that you can start managing taxation, that means that if you can reduce the percentage of taxes that you're paying on your retirement accounts, or perhaps even the income that you're generating if you're still working, or the income that you may be generating from your investments, if you have some passive investments that are working for you, then you're able to offset a little bit of that inflation risk. Now, if you don't do any proper tax planning, you're going to be compounding the problem, because as you start taking distributions because of inflation, you're going to have to take more and more every single day in order to stay ahead of inflation. And on top of that, you're going to have to pay taxes at the highest level that you may find yourself from a taxable standpoint. So someone asked me the other day, and I read an interesting article about the dollar store, and somebody asked me the other day, Bert, what's the definition of inflation? And I wanted to make an analogy, and I said, look, for me, the definition of inflation, and I can give you 1,000 different options along those lines, but for me, the definition of inflation is when the dollar store stops selling items for $1. For me, that's inflation. And they just announced that the vast majority of the items that for decades the dollar store has been selling for $1 is not going to be able to do that any longer. So these items are going to be worth now, if you're going to buy them, you're going to have to pay $1.50, $1.75, $3, $4, because the dollar store is being impacted by inflation as well. So they have to be able to offset the losses of inflation by increasing the prices that you're going to pay when you go to the dollar store to purchase any items that you purchase on a regular basis. Now, for me, tax planning is tax avoidance, and there's a big difference between tax avoidance and tax evasion. Tax avoidance is what you should be doing every single day. You and your accountants and your business, or if you're an individual that is working for a company, you should do tax planning every single day. Now, most accountants are not tax planners. Most accountants, when they do business with you, you're going to bring in your W-2s, your 1099s, you're going to give them all the expenses that you have had, your property deductions, your property taxes that you may have paid, and then that accountant is going to take that information after the fact, of course, and they're going to plug it into their system, and they're going to tell you whether you owe taxes or whether you get a refund or if you broke even. Tax planning is a totally different way of thinking. Most accountants are always thinking in the rearview mirror or looking in the rearview mirror, but very few of them are actually looking forward, and that's where tax planning comes into place. Now, what are some of the things that you can do in order to try to offset the nemesis of taxes and inflation? Because at the end of the day, unless you do something along those lines, you're going to have a very difficult time going through economic survival. So, for instance, qualified plan contributions are temporary tax planning strategies. So I see that many of you, let me get a drink of water. I see that many of you and many of the clients that I have dealt with over the years have been pretty much overfunding or maxing out their contributions to qualified plans. And the reason for that is that it gives you a current satisfaction. If you earn $10,000, if you earn $100,000 a year, and you put $15,000 into your 401k or other qualified plans, then you're only going to pay taxes on $85,000 in that year. So that gives you immediate gratification. The challenge with that is that eventually you're going to have to take that money out. You're going to have to pay taxes on the entire thing at a much greater tax rate than the tax rate that was in place when you saved the money. So anytime that you make a contribution to a qualified plan, whether it's an IRA, a 401k, a 403b, or any of those government plans, just remember that these satisfactions are just temporary in nature, because eventually you're going to have to pay taxes on all that money. Now, qualified plan contributions, also, if you're going to do them the right way, they must be paired with provisional income calculations, because otherwise you're going to be creating the perfect storm. Now, what do I mean by that? Well, when I say that you have to be careful with your contributions to qualified plans, I am not saying that you shouldn't make contributions to your qualified plans. If you're working for an employer and you're getting a match, you should contribute at least to 100% of that match, so you can get that match on your side of the ledger. Now, you may be able to complete a little bit more, but most of the calculations that I've done for clients seldom require my clients to contribute more than 7% of their adjustable gross income. So I'm always very careful when I do those calculations for the clients. And the reason for that is that if you can contribute to a qualified plan under the right set of premises, and you do it the right way with tax planning involved from one year to the next, you may be able to have your cake and eat it too. Now you may say, Bert, what do you mean by that? Well, here's what I mean. You may be able to put money into your 401k and IRA on a pre-tax basis, meaning that you took that deduction in the year that you made the contribution. The money will then grow on a tax-deferred basis until retirement or until such time where you decide to take that money out. And then when you do, if you have done proper provisional income calculations and you have paired those calculations with your contributions to your qualified plans, you may actually be able to pull the money out tax-free. In other words, let me rephrase that. Not necessarily tax-free, but the net to you from a taxable standpoint would be zero, which means the money went in pre-tax, the money grew tax-deferred, and then you were able to pull the money out without having a cost for the use of that money when you took that distribution from your retirement account. So you actually get the best of all worlds. Now, there are many ways of doing that. I don't have the time to go into this right now, but what I can tell you is that if you talk to your accountant or you talk to your financial advisor, please just ask them if they know what provisional income calculations are. Most of them are not going to be able to tell you because that's not the business that they're in, and that is not something that they do. But if you don't do it, then you're going to be creating the perfect storm, because now if you don't do it, when you take money out of your retirement accounts, you're going to have to pay taxes on those retirement account items based on the tax bracket that you're going to find yourself at that point in time. And then because of your lack of preparation, you're more than likely going to have to pay taxes on your Social Security benefits, and perhaps even a percentage of your Medicare premiums will actually go up because of the fact that you failed to do proper tax planning. So always remember that when it comes to provisional income calculations, any income that you generate at retirement, any capital gains that you get, any dividend distributions from your investment accounts, even municipal bonds, although municipal bonds are a federal income tax free to you, they get added to the provisional income calculation to determine what percentage of your Social Security benefits is going to be taxed. And so obviously, if you don't do it correctly, and then on top of that, you're going to have to add any distributions that you take from your qualified plans, like your 401k and IRA, that's automatically going to increase the taxation of your Social Security benefits. And by the way, most Americans are paying taxes on their Social Security benefits. But if they had done proper tax planning, they could have avoided that nightmare, because that's what I call it the torpedo tax, because you never saw it coming. The taxation of your Social Security benefits is based on all the other income that you're reporting on an annual basis, all the other taxable income that you're reporting on an annual basis, and then that determines whether your Social Security benefits are going to be taxed at 0, which would be the perfect way, or 50%, or 85%. So remember, income, capital gains, dividends, municipal bond income, qualified plan distributions may very well increase the taxation of your Social Security benefits. So now you just created the perfect storm because you failed to do proper tax planning. And like I said, for certain Americans, depending on the income that you're reporting on an annual basis, Medicare premiums are increased due to poor tax planning. Now, what does that tell you, or what should that tell you? Well, number one, I think it would be important to cap your qualified plan contributions based on your future qualified itemized deductions and or standard deductions. So one of the things that I do with my clients when I do tax planning, I do forward planning, meaning we look 2, 3, 4, 5 years down the line and do calculations to determine how much contributions can that client or should that client make to their qualified plans over the next 5 years, just to make certain that we don't go over the threshold where now their Social Security benefits are going to be taxed moving forward for the rest of their lives. So that is something that most financial advisors, unless they have a tax planning or accounting background, they're not going to know about it. And I would argue that although there are a lot of accountants out there and CPAs with tremendous accounting background, the majority of them don't do any tax planning. So I do encourage you to visit with someone that can help you. Now, obviously, you can always reach out to me and I'll be more than happy to help you along those lines. Now, what are some of the other tools that you may be able to use? Roth accounts are excellent tools for future tax avoidance. Remember, when you put money into a Roth IRA or Roth 401k, the money that you put in is after tax, so you didn't take that immediate gratification, but you're going to get a delayed gratification that is going to be much, much greater than that immediate gratification that you would have received had you put the money in a traditional IRA or a traditional 401k. And the reason for that is that Roth accounts, the distributions are totally tax-free. Now, Life insurance, which falls under IRS Code 7702, life insurance and 7702 plans are excellent tools for future tax avoidance. And we all understand that taxes are going to have to be a lot higher in the future or our country's going to go bankrupt. Now, I don't know what's going to happen at the end of the day with what's going through Congress right now from a taxable standpoint, but I will argue that all of us are going to be impacted by taxation. Don't believe any politician that tells you that, no, I'm just going to be, taxing people that make at least $400,000 and anyone below that, they're not going to be taxed. You will be taxed. And the reason for that is that there are not that many individuals in this country that make over $400,000 that is going to be enough to pay the debt. And on top of that, who are the vast majority of people that make over $400,000? Well, the vast majority of them are small business owners. So you think that if you raise taxes on small businesses, what do you think they're going to do? They're going to pass that cost to you and to me as a consumer. And so what they're going to do is that tax that now is impacting them, because now the tax is greater than what they had forecasted for the year, they're going to pass it on. They're going to add it to the products and services that they provide to us, the consumers, on a regular basis. And that is going to increase the inflation and the pricing of those products. So at the end of the day, we're all going to be paying for that cost, whether we want to or not. So I do encourage all of you to make certain that you pay attention to tax planning and also pay attention to your inflation. So the Roth IRA and Roth 401k accounts are excellent because when you pull the money out, under federal law, you're not going to have to report them for taxes, and they're not going to have a negative impact on your Social Security distributions, and they're not going to have a negative impact on any potential increase of Medicare premium due to the reportable income on an annual basis. Now, for those of you that happen to be in real estate, I do feel that real estate leveraging is an excellent tool for tax avoidance and or tax reduction. So if you're a real estate investor and you have rental property that you rent out, there's a lot of things that you can do to offset the gross profit of those properties. So, you're going to be able to take deductions. You're going to have to all the expenses, all the repairs. You can do a lot of things that you would otherwise not be able to do with any other type of investment. So real estate is going to give you a buffer because you're going to be able to reduce the gross profit margins on your real estate investments from one year to the next. You can also take depreciation, which reduces that cost. Now, temporary, albeit because once you sell the property in the future, then that depreciation is going to be recaptured. But at least it's going to give you the leverage to be able to reduce those potential liabilities, tax liabilities, from one year to the next. Also, for most of you, let's say that you have a second home. For those of you that live in Florida, you may have a second home in the Keys. I don't know if you're aware of this, but there's a rule called the Augusta Rule, which allows you in many different ways to rent out your home or your second home, as long as you do it for 14 days or less. Any income that you generate from the rental of that property for those 14 days is totally tax-free income to you. Now, you cannot report any expenses for those 14 days, but all of the income that you generate, so if you're renting the home for, $1,000 a day and you rent it for 14 days, that's $14,000 that will not be reportable from an income standpoint. You can actually take that money and put it into a Roth IRA. So now you generated the income on a tax-free basis, and now you're going to make that contribution to a Roth 401k, let's say, because an IRA you're going to have limitations. But at least in an IRA, you can put half of it in there as well. And now the money's going to grow tax-free for the rest of your life. So you generated the income without having to pay taxes. And on top of that, you put that money into an account that was a Roth account and guaranteed never to pay taxes ever again. So that's a win-win that most of you are not aware of. So if you're interested, feel free to reach out regarding the Augusta Rule, and I'll be more than happy to help you along those lines. For those of you that own a business, there's a lot of stuff that I do for my business clients. The question is, well, are you on cash or accrual basis for accounting purposes? And depending on the type of business that you run and how your payment for services are made, for some of you, it may be a good idea to be on a cash basis. For others, may be a better idea to be on an accrual basis. But those are things that you should be talking to your accountants about as well in order to make that proper determination. Because at the end of the day, it's not how much money you make, it is how much money you keep. And always remember that even a broken clock is right twice a day. So if you really want to fix the future of your retirement and your retirement distribution planning, with all the stuff that's going through Congress now, all these tax increases, all this borrowing, all this printing, I don't know whether we're going to get to that $3.5 trillion of additional expenses, or it's going to be something less than that. But whatever it is, someone is going to have to pay the piper, and we're going to be the ones holding the bag, because the middle class is the one that is always going to end up holding the bag along those lines from a business standpoint. So I'm hoping that I was able to give you some good information today. Always remember that if you want to reach out to me, please feel free to call me. You can reach out to me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And please, don't forget to, let me do a little plug-in on my book. Go to Amazon, you can download my book, you can buy the paperback if you want as well. The name of my book is Retirement Paradigms, Managing Retirement Risks in the 21st Century. It's a great book. A lot of the stuff that I talk about and that I have talked about in all of my 162 podcasts, a lot of that information and more is already on the book. The book launched in January of 2021, is doing well. So I would appreciate if you can buy it, because it's going to help you. It's going to give you a tremendous foundation, retirement foundation and planning foundation for you and for your family. And always remember that my goal is to kind of help you and your family change the way that you see things. Because when you change the way that you see things, the things that you see change. So once again, thanks very much for your time, and I'll talk to you again next week. Take care. Bye-bye.